What's going on? Welcome to my channel. I am the covered call guy, and my goal is to create $120,000 per year passive income portfolio using only covered call ETFs. Right now, I yield about $72,000 a year, $6,000 a month, $1,400 a week, and about $200 per day. I am going to be updating this at the end of every month, so in about a week and a half, hopefully, I would have crossed or at least hit $75,000 a year. And talking about crossing it or hitting it, this video we're going to be talking about how it's going to affect my premiums, right? It's going to affect your premiums, and if I'm going to make that goal or not of $75,000 before 2025 ends. But before we get started on this video, legal disclaimer: this content is for information and educational purposes only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed on my own and may be inaccurate or incomplete or just flat out wrong. Investing and trading involves significant risk, including the possible loss of principal. So please always conduct your due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I'm just some random idiot on YouTube and I could be completely wrong. Now let's get started on December's choppy market and how that could affect our income strategy and our income in general. Right? Change your panic to compression. Don't panic when the market's choppy. When the market is flat and or choppy, cover call ETFs, income investors, we do well in those, right? We don't exactly want a crazy raging bull market. We want the market to stay flat and or choppy. And we're going to be talking about November to December volatility cycle and how that has affected our premiums, so we better understand how December has been affecting us. And December is halfway through. So let's figure out if December is going to close out choppy enough for our premiums to be nice and juicy. Right, the November panic, the VIX was over 26. What does that mean? Remember late November, you saw a massive volatility shock. The spike VIX closed at 26.42 on November 20th, with intraday peaks even higher. I think the cause was a triad of anxiety, right? Global tariffs, Fed uncertainty, and tech capex fears. The reality, though, this was a systematic repricing of risks, not just a blip, right? I talked about in my previous video. I just think people are starting to reprice and re-rotate into different sectors. All right, the December crush, right? The narrative has flipped. As soon as the calendar turned, your panic should have turned into relief. Why? The volatility crush is here. It's the new normal, I think. By mid-December, where we're at mid-December, the VIX compressed to the 15 to 17% range. The cost of insurance has collapsed. You are now in a market of managed uncertainty, not imminent disaster, okay? The VIX has just gone from over fear to now kind of a bit calmer, right? We are not really seeing these crazy waves. We are just seeing more of a up, down, just a little blip. Right, daily trends, right? Stabilization. Let's talk about this, right? From December 8th was 1666. Opening gap volatility faded away. December 9th, 1693. Resistance held at 1720. December 11th, VIX closed at 1485. That we saw as at the bottom, right? Decisive breakdown of support. December 12th, 1574. Intraday volatility tested 17 before settling. And then today, December 15th, closed at 1699. Pricing in final pre-Fed jitters, right? So the floor near 1485 should tell you the shock is absorbed, but structural risk remains. So as it starts peaking higher and higher again, we are going to see more juicy premiums, right? It starts going back into the fair. Right, future expectations, right? Contango. This is just kind of my take and my guess. We saw the spot VIX at from December 12th at 1574, January 2026 futures at 1855, February 2026 futures at 1978. What I'm just saying is pay attention. The market is pricing in a calm December, but hedging for a stormy January, right? This Contango is a warning sign for your 2026 outlook. So let's not panic. Let's just brace for it, right? That is why I always say have your dry powder ready, right? We embrace these stormy and choppy markets. We love them. We embrace them. This channel, don't be afraid, okay? Why the shift? I think it was caused by these three factors. Again, this is my guess. I could be wrong. Factor number one, the tariff factor, right? The market hates uncertainty more than bad news. Okay, I don't think you guys are understanding that enough. The market hates uncertainty more than bad news. Tariffs are now priced in as a drag, not a shock. Okay, the ambiguity premium has vanished. It's starting to settling and saying, all right, the tariffs are here to stay. Right? Fed clarity, right? The will they, won't they is over. Markets are pricing in and a 90% chance of a cut. The event risk is discounted. So unless the Fed absolutely flipped the script, then we would be like, ooh, market got it wrong. And then it just, that's not a bad thing either, right? As markets kind of like get stuff wrong, the VIX kind of spike one way or the other. It's not a bad thing, especially for us who count on these premiums, right? Sector rotation, right? Money is rotating from tech to industrials and healthcare. I made a video about this. Please check it out, right? This broadening out dampens index level volatility, so it just kind of help flatline it, right? That is kind of hurting us, us income and a cover call ETF investors. Why? Because industrials and healthcare are more they're more flatlined, right? They don't really do anything, right? They're more stable. They don't really have that jump in um, volatility, right? No, income November versus December. So November windfall, when VIX spiked over 26, you saw a massive opportunity. For example, XYLD collected almost 3% premiums. QYLD collected almost 4% premiums, right? The result, max distribution reach, right? So versus December, we have to face the reality of December, right? With the VIX at about 15, that risk has evaporated. The trade-off, now these ETF fund managers must choose, right? Accept significantly lower yields or right calls close to the money, risking capped upside, right? They could still write out of the call money and just let things settle and see what happens. All right, the choppy trap, right? Let's not get complacent. Sideways markets are great for data decay, which just means time erosion benefits us, right? Ideally, we want the market to stay flat, right? But here's the risk. The premiums you're collecting in December are smaller, as we've seen. If we get a Santa Claus rally, these small premiums won't cover the gains you miss out on. We're picking up pennies in front of a steamroller. So we have to understand that trade-off here, right? For those who don't know, a Santa Claus rally is categorized generally by stock market gains, right? And that would actually likely reduce the VIX premium, as the VIX typically move inversely to the stock market, right? So if that happens, I'm going to say a rally might suggest lower expected volatility and market calm, which directly leads to lower option premiums and a lower VIX. Not exactly what we want at times, right? So, the VIX is often called the Wall Street Fair Gauge, right? So we sell fair. I've said this multiple times in my video, right? Option we when we sell these well, not we, but these fund managers sell these options on our cover call ETFs, right? We're selling the fair, right? The more fear, the more uncertainty, the more chaos, the higher the premium is, right? So hopefully we don't get a crazy rally, because that would actually not work out in our favor. All right, where's the juice, right? Single stocks, right? Index versus single stocks. The VIX, which is an index, is at 15, but single stock volatility is much higher. You need to look under the hood. Our case study, I'm just going to use CVS. It's a health stock, right? Even defensive stock like CVS are offering about 4.6 annualized Yield boost from premium alone, about 10% out of the money, right? Case study, XP Inc. High beta names like XP show 78% implied volatility, right? You can find over 11% yields, even 11% out of the money, right? So that's some cases you can use, and some um, how to build your portfolio around, but that is just examples, right? We might not want to stay with the single stocks just for these reasons. We want to just realize what can happen and where the money and the premiums go to. Right, passive giants, the struggle, right? QYLD and XYLD. I'm gonna say these are the first gen funds. They're rigid, right? They sell at the money calls no matter what. The performance, QYLD is up 7.6% year to date, significantly lagging the Nasdaq 100. The result of that is that investors are leaving. QYLD has seen a $53 million in outflows. Not good. The problem, why? They're selling upside in a cheap rising market, and that is hurting the total return. Right, active challengers, the winners, right? JEPI from SP 500. The strategy is to participate and protect. They use out the money calls, right? Performance 7.17% year to date, very stable, with flows of 4.35 billion in inflows. My verdict: a juggernaut for defensive income, and also JEPQ from Nasdaq. Their strategy is active tech exposure, performance plus 15.87% year to date, right? Double QYLDs. Their flows positive 9.64 billion in inflows. My verdict here: the clear winner for tech income right now. That is some picks that you can choose, right? For these, when the VIX is doing so terrible and we're not collecting these premiums, these are some options, right? They don't move much, but they collect the money. Right? Aggressive income, high beta. Right? You can also turn to zero day time expiration funds, QDTE, right? These harvest intraday volatility in a choppy market with no overnight gaps. These can work well for weekly income. For those who own it, how's it been treating you, especially in these choppy markets? But what about Yield Max, NVDY? Boasts an 89% yield, but beware, right? The trap and a short volatility bet. If Nvidia drops, you lose NAV. If it rallies hard, you are capped, right? Dangerous for long-term holds. Of course, if you are new, this is something you have to be aware. And for those who's been around the channel, you already know the risk. All right, let's talk about the analysts, from these big hedge funds talking about the 6,900 wall, right? Technical reality. The S&P is hitting a formidable resistance level between 6,800 and 6,900, right? Binary outcome for us. One is the rejection. If we fail here, cover calls outperform, right? They buffer the drop. Two is an outbreak. If the Santa Claus Rally smashes 6,900, passive funds face maximum regret risk. And if you hold passive funds, right, you have to be aware of those. I'm talking specifically passive cover call ETFs. All right, January 2026 forecast. I could be completely wrong. These are just my guesses, right? We have QYLD, passive at the money. My outlook for 2026 is going to keep declining, right? Lower December premiums impact January. We have JEPI active out the money. I'm still going to say it's going to be stable, right? Defensive floor helps. JEPQ active out the money. This one is moderate, right? Tech volatility supports yield, and tech has kind of been slipping, so we'll have to see. RYLD small cap. I want to say this one is high, right? Rotation keeps premiums rich. So again, start looking at your strategy and how choppy markets, flat markets affect your cover call ETFs. All right, your portfolio, the barbell. Of course, I'm going to say this is how we should play it, right? Core allocations could be active cover call ETFs, and some examples are just JEPI and JEPQ, right? If you're new, you might want to anchor your portfolio here. There are better, not quote unquote better, but there are other options. I'm just using these two as an example, okay? right? You can have these two. You need to participate and protect to handle a potential outbreak. And what do I mean by that? You have the tactical play here, right? Call spreads or SPYI, right? These use tax efficient spreads. These capture the melt up better than standard calls, right? So you've always formed these two together. These are just examples again. Depending on what you want, you can choose different call spreads, strategies, and funds, and you can always choose different active call strategy and funds, right? But however, I would completely avoid passive at the money like QYLD, right? In a low VIX world, selling at the money calls is mathematically inefficient, right? Don't sell your upside cheap. Stay away from these. My verdict here, right? The free lunch is over, or at least I think it is, right? Rigid strategies are a liability. Pivot to active management to secure income without sacrificing the potential gains of 2026, right? Embrace the active shift. Do not be afraid of these choppy markets. Embrace them. We love choppy markets. We love flat markets. It's okay. It's fine. Okay? Don't panic sell. Remember, the end goal here is income. Okay? If the NAV drops because the market is choppy or flat, that's fine. That is 100% fine. That is not NAV erosion. So understand the difference. If you enjoyed this video, found it educational, informative, please smash that like button, right? Comment your strategy. Are you still staying with active or passive, right? And subscribe for more updates on the volatility regime. I will try to be making more updates on these. The market has been very kind of surprising, right? We thought it would go up, but it didn't. Now it's just dropping, and it has a little jump. But as cover call and ETF investors, we are okay with that. And let me tell you, I am okay with that. I continue to buy. If the dip keep coming, we continue to buy. Thanks for watching, guys. Catch you guys in the next. Stay tuned.